Hello everyone and welcome to my channel. Today we continue learning about purchase discounts from the purchaser's perspective. As we learned in part 1, when accounting for purchase discounts, there are two methods to choose from, the gross method and the net method. Today we will look at recording journal entries under the net method. This slide shows a side-by-side comparison of how transactions are recorded under the gross and net methods. The gross method was discussed in part 2. I'm posting the link here and in the description below. Note that both slides are for the periodic inventory system. Under the perpetual inventory system, purchase discounts are credited to inventory rather than a separate expense account. Let's look at the net method. When a company uses the net method under the periodic inventory system, it records the purchases and accounts payable at the amount that will be paid after any early payment discounts have been applied. In other words, the discount is recorded upfront, as it is assumed that the payment will be made within the discount period. The net method is considered better for two reasons. First, it provides a correct reporting of the cost of inventory and related liability. And second, it can measure management inefficiency by holding management accountable for discounts not taken. However, the net method is considered more complicated compared to the gross method, and some believe that it is not justified by the resulting benefits. The first journal entry is to record a purchase of bicycle inventory with the cost of $10,000, terms 210, net 30. Since the net method is used, both debit and credit are for $9,800. The purchases account is increased or debited, and accounts payable is increased or credited. $9,800 is the net price and is calculated as the total invoice of $10,000 minus the discount of 2% or $200. Just a reminder, assets and expenses are increased by debit and decreased by credit. Liabilities, on the contrary, are increased by credit and decreased by debit. If you need to review the rules of debit and credit, I'm posting the link to the video here and in the description below. The second journal entry is to record a payment for invoices of $4,000, which were paid within the discount period. Let's briefly review what 210 net 30 means. 210 net 30 means that the buyer will receive a 2% discount on the net amount if they pay the invoice in full within the first 10 days of the invoice date. Otherwise, the full invoice amount is due in 30 days without a discount. The journal entry is recorded as follows. Accounts payable is decreased or debited for $3,920, which is $4,000 minus the previously deducted discount of $80, calculated as 2% of $4,000. Cash is decreased or credited by $3,920. It can also be calculated as $4,000 multiplied by 98%, where 98% is the net amount of the invoice, or 100% less the discount of 2%. Note that accounts payable needs to be debited for the net amount of the invoices, as the discounts were taken up front and the invoices were originally recorded at the net amount. The third entry is to record the payment of invoices of $6,000, which were paid after the discount period. Accounts payable is decreased or debited in the amount of $5,880. Since the company recorded the discount upfront but didn't pay within the discount period, the discount was lost. This loss is recorded as a debit to the purchase discounts lost account. The debit is for $120, which is $6,000 multiplied by 2%. Cash is decreased or credited for the full amount of the invoice, which is $6,000. The account Purchase Discounts Lost is a general ledger account used by a company that records vendors' invoices using the net method. It's the amount a purchaser could have saved if they had paid their invoices within the discount period. A debit amount is entered in Purchase Discounts Lost when a company fails to pay a vendor's invoice within the vendor's early payment discount period. Purchase discounts lost are aggregated for reporting to management and used for subsequent analysis to improve the payment processing procedure. The amount in this account is usually too small to report separately in the financial statements, so it is instead aggregated into another line item for reporting purposes. This account is treated as either an operating expense or an interest expense. Treating discounts lost as interest expense is justified by the fact that the company made a deliberate decision to not pay within the discount period, resulting in an added cost. This added cost is viewed as the cost of using money and is classified as interest. On this slide, you see a T account for accounts payable. Accounts payable is a liability account. Its normal balance is credit. It is increased by credit and decreased by debit. First, it was increased or credited by $9,800, the amount of the invoices less a purchase discount, and then decreased or debited by $3,920 and $5,880. Note that the ending balance in the accounts payable account after all invoices are paid must be zero. That's all for today. I hope you found this video helpful. If you did, please subscribe, hit that like button and ring the notification bell so you are notified when we release more videos like this. Visit my channel for more videos on financial and intermediate accounting. Thank you all so much for watching, and I hope to see you all again in the next video.